Hey there guys, so I have neglected this channel for quite some time, and so I decided that for a while now I've wanted to do a series that takes you through the process that I use to identify stocks that I invest in and stocks that I choose to stay away from. And I've done a few videos on that in the past, but I wanted to do a brand new series, and we're going to do once a week a new video tackling another company, tackling a new company, all FTSE companies, from the FTSE 100 to 50, the small cap, the fledgling, and the FTSE AIM market. So, without further ado, let's dive in. Okay, so welcome to this new series, episode number 1. Today we're going to look at one of many different options of companies that we can look at. Before I do though, I want to establish some kind of ground rules, if you will, some guiding principles, a caveat, I suppose, or a disclaimer around what I intend this series to be. Because there are many different ways to invest in shares and stocks, and different ways to approach it, different focuses. So I want to lay down the foundations of what I'm doing and why I'm doing it, so that when we go through the data together and we look at the charts and we look at these companies throughout this series, you'll understand where I'm coming from, what I'm personally trying to achieve. Whether or not you want to replicate that yourself, up to you. If you just want to use it to kind of get an insight into a different way of doing things, perfectly fine. If you hate the videos, don't watch them. But I want to go through some guiding principles with you so you can understand where I'm coming from. So first of all, I'm not looking for dividend stocks. So many investors out there are focused on buying shares in companies because they produce a high dividend yield. They produce big dividends throughout the year in relation to other companies, other shares. That's not me. I'm not interested in that. I'm more interested, and this is just a personal preference, if you will, way more interested in stocks where I can buy shares at £3–4 a share, and in 5–10 years they'll be up 30 quid, £30 a share. I'm far more interested in the explosion of that opportunity than relying on dividend payments every year. I still get dividends from the shares that I hold and I invest in, but they're not as strong in terms of dividend yield. Some of them are, some of them aren't, but it's not my focus, not what I focus on in terms of, it has no bearing on my stock selection criteria whatsoever. Secondly, I'm looking for stocks that are likely to rise over the next 1 to 5 years, maybe longer. So I might be holding some of these shares for a lifetime. I may never sell them. I may pass them on to my children. Who knows? But at minimum, I'm looking to hold these companies for a few years. Roughly around 5-year period. So it gives you an insight into where I'm looking in terms of my thought process. I'm not looking to turn these trades around within a couple of months. I'm looking to hold these for years. So it gives you an insight into what work is going into, why I'm looking so deep into these companies, and why I'm willing to invest within them. I am focusing on facts alone. I'm not interested in any opinion. Some of these companies are household brands. They're big names, big British staples, and I have no affinity to any of them in this process. Now I do, there are some brands and companies that I like to use purely from personal experience, but that has no bearing on my selection criteria. I'm only interested in the facts. I don't care about what analysts are saying about this. I read analyst reports on newsletters that say, I think this is going to happen, I reckon this is going to happen, I believe this is going to happen. Well, I'm not interested in that person's opinion on that. I want to know what are the facts. That's all I'm interested in. And so I personally am only interested in looking at the facts. That's all we're going to be doing together on this series. You'll hear no opinion on what I think is going to happen or which companies I think are going to do well. We're just going to look at the actual numbers and see what they tell us, essentially. So another thing I'm not interested in at all is the CEO's opinion and outlook on that business. I hear a lot of advice from institutional investors. You see it online, you read it in a lot of books, that you should read annual reports to see what the CEO is saying about the business and how positive and optimistic are they about the business. It's rubbish. I've looked at hundreds now of annual reports, hundreds, maybe even getting close to the thousands. I don't know. I'm probably not quite there, but hundreds and hundreds of annual reports. I don't know if I've ever read an annual report where the CEO wasn't optimistic about the company. You know, they're not going to write anything pessimistic about their business. You know, they're always looking for that little statistic that they can hang on that sounds good. You know, that is just the way these annual reports are. Just bleh. When you read them, it's just like, oh, record growth, we're doing great, and you're just like, yeah, show me the numbers. So, you know, this investment advice of looking at what CEOs are saying about these companies, about their own companies, and how optimistic they are, that's bad advice, because they're all optimistic. It doesn't add any value at all to the process. I'm also not interested in directors' own personal dealings and shareholdings within that business. Some investors will tell you that you should only invest in companies where the directors of that company are buying more of the shares in that company. And on the face value, that is, you know, it makes sense. It's common sense advice, right? So if there's a company and the directors are buying lots of shares in it, it means they're positive about their business, and they're so positive about the business that they're willing to put their own money on the line. So that's another level of just being optimistic. That's actually, they're putting their money where their mouth is. Totally cool. Get it. However, I have seen so much evidence now, having done this for quite some time and looking through these annual reports, of directors still buying more shares in companies moments before they've just fallen apart. As in, for example, we look at Thomas Cook PLC. So you look at Thomas Cook, and the warning signs for Thomas Cook were evident from 2014 onwards. So between 2014 and 2019, they were just falling. And I'm not talking about share price, although that was falling as well. I'm talking about the fundamental, the financial numbers within that business. They were hemorrhaging money. They were losing money. They were, the profit was dropping and dropping and dropping. The revenue was falling. Everything was looking really, really bad. You wouldn't have been anywhere near Thomas Cook. I certainly would never have been anywhere near buying shares in Thomas Cook at any part of that process. From the moment that things started to look bad, I would have stayed well out of it. But directors within Thomas Cook were still investing their own money in more shares. As the share price fell, it got cheaper, and they started to buy more and more and more. Thomas Cook doesn't exist anymore. We look at Debenhams PLC, the famous Mike Ashley, owner of Newcastle Football Club and Sports Direct, I think he owns, Sports Direct International. Over the last 5 years of Debenhams PLC, their finances looked bad. You know, the warning signs were all there. The expenses were just getting far too expensive, and they were wiping out the profits of the company, and things were not looking good. The share price was plummeting. Mike Ashley was buying more and more shares every single year until he ended up losing his entire stake of £150 million because he was buying shares in a failing company. What this tells me is that the directors don't necessarily know what they're doing. What it tells me is that I should not be relying upon their actions to dictate what I should do with my own money. I should not be following them in that respect. And so if a director is buying more shares in any company, great, good for them. But I want to know, what are the facts? I want to know what's actually going on in that business. I don't care about what the directors are doing, because it doesn't give me a reliable insight into what I should do with my money, if that makes sense. I'm not really that interested in the product or service that any of these businesses sell. Again, it's traditional investment advice that you will read and other people will tell you. Some well-respected investors will write in, you know, their books that they've written. I've got a lot of them behind me. They'll tell you that, you know, if you love a product, you should invest in that company. There's a guy on YouTube, and I'm not going to, you know, start a YouTube war, but there's a guy in the US who does this sort of stuff, and he was talking about, I was watching one of his videos recently, and he was talking about this product that he personally uses, and he loves the product, and he uses it every day, and his wife uses it every day, and you should invest in this company because they produce great stuff. And I thought to myself, well, no, I would never put an investment decision based on the quality of a product, because it's opinion based. You know, one person likes it, one person doesn't. And here's the underlying rule of this, is that the numbers themselves will tell me if they've got a good product or service. The financials will tell me, because other people in the world will like their product and service and they'll be buying it. And so you'll be able to tell from the numbers whether or not this company are producing a good product or service. It shouldn't be down to what I personally think about that product, I don't believe the two are correlated. I don't believe my opinion on a product has any correlation to the actual financial performance of that business. Where my opinion does kind of come into play a little bit, where I get that kind of 2% little leeway, is that when I'm looking at companies, I will factor in the idea of, will this company be around in 5 years' time or not? You know, we can look at companies like HMV, who are selling DVDs and CDs. Then the digital age came in and people started to download their films, download their music. Opportunities and options to be able to download that stuff in the mainstream became available. You know, you didn't have to just pirate download everything. It started, you actually were able to start buying stuff from iTunes. And HMV never got on board with that, really. They were still trying to flog off the DVDs and the CDs, and so that they didn't survive. You know, they fell apart. And it's a kind of a trend, looking at trends, trying to identify where are things going, where are these companies going, will this company be around in 5 years, will there still be a need for this as technology improves. There's an element of that in my decision making. However, even that is often factored in the numbers. When you look at these companies that didn't jump on board, you know, the Kodaks, when digital cameras came out and they just died, you know, there are companies out there, you'll see all of these financials will tell you that there's a problem well before there's a problem, if that makes sense. So the numbers are what I rely upon. The numbers will tell you the story of what's going on, essentially. So I'm not interested in the product or the service that they sell directly, and I have no affinity to anything like that. I also like to remove any extraneous income or costs. So what I mean by that is that I'm interested really in the recurring revenue of that business. What's going on front in terms of the day-to-day business that the business is known for. There are many companies that will post record profits this year, and then when you dig deep into the numbers, you find, well, actually, it's record numbers because they sold this element of their business off to some company in China and made, you know, millions of pounds from it, which is great from an accounting point of view. Yeah, record year, but what did the recurring business do? What did the everyday element of your business actually achieve without that big sale? Because you're not going to be relying on that next year. And I see that a lot of investors making this mistake, where they'll see record numbers, record revenue, you know, record profits that year, and they'll invest in a company just off the back of that news. And then when you look through it, the very next year that company's share price drops. And it drops dramatically, and these investors that invested lose a load of money. And the reason why that share price drops is because the following year their profits are right back down. And they're right back down because they don't have these arms of their business that they can sell off to China every single year. They're back to just relying on the recurring revenue of their business. And so I extract that. I call it the extraneous circumstances or extraneous income. I cut it out of the process, and I'm only interested in what the recurring revenue of that business actually is, and that's what all my data is focused upon. I'm not interested in mining or exploration stocks purely because I don't personally understand them. Warren Buffett's often said in the past, you know, stick to what you know. He's always stuck to what he knows and invested in companies that he understands. I don't truly understand the mining and exploration industry. I've run a lot of analysis on these companies. They seem to carry a ton of debt. They rely on investment every single year. Can they get the investment every single year? They're running around trying to find investors to keep them afloat because they're hemorrhaging millions in their operational costs of mining and exploring and trying to find rare precious metals or whatever it is they're mining for. And if they don't find those metals each year, they're just losing and losing money. And as an investor, investing in a company like that, you're banking on that company finding the thing that they're looking for and finding enough of it to pay off their losses and make profits. Now, that works for some mining companies. And for some people, that kind of gamble is very appealing to some investors. For me, not so much. I'm rather look for companies that have a track record of success, in businesses, traditional businesses that I fully understand. And so I'm not interested, and I don't do any further analysis on mining or exploration stocks. There won't be any involved in this series. And the caveat that I want to finally end with is that some stocks that I choose or pick or select as companies that I'm invested in, and some companies that I don't invest in, they may go up in value in the future. Companies that I'm not interested in may go up in value in the future. And I'm not here to say that those companies won't go up in value. However, what I'm trying to do here is I'm looking to dramatically increase the odds of my stocks going up in value by cherry picking only the best of the best, the excellent stocks out there that I can choose to put my money into. There's a huge, vast, range of companies that we can be investing in. Some of them are dog poor companies that you just wouldn't put your money in. Some of them are average, but you wouldn't put your money into them. Some of them are pretty good, but again, I wouldn't put my money. They might produce really good numbers, but they're just not as good as the best. I'm only looking for the best. I only want to invest in the best, because by cherry picking just the best companies from the FTSE 100, 250, small cap, fledgling, and the AIM markets, I'm putting the odds greatly in my favour of the share prices going up over the next 5 to 20, 30 years, whatever it might be. So that's my thought process. Those are my guiding principles that are going to kind of build the foundation or set the foundation for this entire series going forward. All the companies that I look at, those are the guiding principles that surround it, that are behind it. So with that, let's have a look at the first company for episode number 1. Okay, so the first company I want to look at are a company called AA PLC. These are a very well-known brand in the UK. They are the automotive breakdown specialists, recovery people. And this is, an example of how I don't allow personal bias to come into play here. I use AA myself. I am an AA member. So when I break down in my car, which has happened once or twice in my life, AA are the people that I call, and AA are the people that come and rescue me and get me back on the road. And, they've always done a great job. And no concerns there whatsoever. However, I'm not going to let that personal bias or personal opinion influence my decision making on whether or not they're a good company for me to invest my money into. It has no bearing whatsoever, no impact whatsoever. I'm purely looking at the financial numbers here. And these are the financial numbers that we have here in front of us of AA PLC. Now, typically I will go back to 10 years worth of financial data. However, on this occasion, 10 years worth of data wasn't available to me. I can only get 8 years. So I'm looking from 2012 to 2019, which is more than adequate, more than enough to identify the trends that are going on here. And the reason why I look at 10 years or 8 years worth of data, a lot of people will say to me, and other investors will say to me, well, it's a waste of time. There's no point in looking at what the company was doing back in 2012. It tells you nothing about this business in 2019. They've changed. There's different staff. There's different, ideas going on. Absolutely agree. Totally. 100%. However, what it will tell me is what are the patterns? What are the trends? What's been happening over those 8 years? Where is this company going? Where has it been? And it adds massive value to me in terms of identifying the overall trend of where this business is going, essentially. And so I get a lot of value from looking at this. The first thing that sticks out in my mind here with AA PLC is the revenue. The revenue is capped. It's stuck. It's 973 million in 2012, 979 million in 2019. There's no revenue growth in this business. Over the last 8 years, we're still stuck at the same level that we were 8 years ago in terms of revenue coming in. So that tells me that this company is struggling to grow. They're struggling to go to the next level. They're struggling to find ways to make more revenue as a business. And you can kind of understand that. I mean, this is a breakdown recovery company. The population is increasing, so you would in theory think that slowly more and more drivers are hitting the road. They're going to need more breakdown. But then there's competition, more and more competition out there with Green Flag and REC and all these other businesses out there that are providing this breakdown service. And so obviously the numbers are telling us that these guys are struggling to grow the business from a revenue point of view, from being able to find more revenue, whether they're finding more customers but having to reduce their prices or whatever it might be, but they're struggling to achieve more revenue. Now we can look at the cost of sales. Cost of sales have largely been the same as well, from 385 million to 399 million over the last 8 years. So the cost of sales is roughly about the same as well. There's no growth in revenue, and the cost of sales is stuck around the same sort of value as well. Here's the thing that stands out the most immediately to me. It's the expenses, the company expenses. We're talking about property, we're talking about rents, we're talking about staff wages, we're talking about advertising, marketing, all of that kind of stuff, utilities, the costs of running the business. they're going up. And they've been going up for 8 years now. And as you can see from 2012, we're looking at 283 million spent on expenses. We're now at 361 million in 2019. And forget the dates up here, by the way. These dates are incorrect. Obviously, this has been recorded prior to that date. It's clearly not correct, but it is 2019's data in this column. I apologise for that confusion. But yeah, so the expenses are going up, and we can see here as a percentage of the gross profit. Which gives you a better inclination of what's actually happening here. You know, we're looking at from 48.1%. We've pretty much, over the 7 years between 2012 and 2018, stuck at about the same amount of expenses relative to the gross profit. But in 2019, this has jumped quite considerably. The expenses of this business have jumped quite a bit, which is a bit of a kicker. But so then we go down, so right now I should probably add no major concerns at this stage, right? Revenue's capped, it's not growing. I'm not really interested in companies that aren't going anywhere and haven't been going anywhere for the last 8 years. So straight away, for me, that's the first no. That's the first warning sign that this is probably not going to be a company I want to invest in. Then growing expenses that are growing faster than the revenue coming in. Again, not interested. I mean, look at this, from 48.1% to 62% now, expenses of the gross profit. That's the percentage of the gross profit that's been eaten up by expenses. So they're clearly going up, clearly not in the direction that I'm looking for. Clearly they're going to struggle to grow if their expenses are growing and the revenue is not growing. So this is not a company I'm going to be investing in. I already know that from this, just that, enough information to tell me this is not a company I'm going to spend any real time on. But we can have a look at the operating profit here. This is the profit that's left over after all the expenses have been taken out. And as you can see, 305 million in 2012, down to 219 million 2019. So it's not been a steady decline as such. I mean, again, those 7 years there, they're all pretty much the same. But last year, we've seen a drop in the profits, obviously due to the fact that the expenses have gone up. This is another concern here, though, the interest on debt. So 2012, 2013, no major issue. You know, the interest they were paying on finance, on debt, wasn't very high. It wasn't taking up a big chunk of their profits. Everything was good. But then from 2014 onwards, and this is the year they floated on the stock market, which you'll see on the chart in a moment. They floated in 2014, and from that point, they've had to borrow. So I'm not entirely sure what the borrowing was for, but you can see here the interest that they've had to pay off on their debt is 179 million. That was nearly 50% of the operating profit that year. So nearly 50% of the operating profit that was left was then eaten up by the interest just on debt alone. The interest alone on that debt, not the debt itself. So yeah, pretty bad. And as you can see, the interest on debt has actually gone up. Not so much in monetary value, but in terms of the drop in operating profit that we've seen, the relation of the interest on that operating profit we look at in a percentage basis. And you can see here, there's some years where it's just become out of control. 2016, for example, 97.3% of the operating profit was eaten up by interest on debt alone. So, I mean, we'll see in a moment, but that year they didn't make any money, they lost money. This is a sign that this company are borrowing way more than they should be in relation to the revenue, to the profits that they're keeping, to the expenses, all this kind of stuff, to the size of their business. It means the debts are really causing them problems right now, and they need to pay that off to reduce the interest. And then we can't really do much about taxes, not much we can really talk about taxes. They are what they are. They don't have a lot of control over that. So we come down to the net earnings. Now, 2012, 2013, the net earnings rate were pretty good. You know, it wasn't too bad, 20%, 23%. So that's the slice that the company gets to keep at the end of the year, essentially, from the revenue. Okay, so once everything's been deducted, what's left for the shareholders and the board, and how are they going to then? It's a case of how are they going to invest that profit? Are they going to buy assets for the company to grow the business? Is there any assets that they can buy? Can they buy more property, more equipment to increase profits? And essentially that's what we want to do, is buy assets, because assets put money in our pocket. Or do they want to put the money in cash reserves so they can then save up for acquiring competitors or acquiring other businesses, that sort of thing? And that's what they do with that profit. Or they'll pay out dividends, obviously, to the shareholders as well. A certain percentage of that will go out on dividends. But as you can see, 2014, the year that they then floated on the stock market, the results started to then go downwards. And from their float, things have not looked good with this business. We're talking 2014 onwards, things have not looked pretty. And so it wasn't so bad in 2014. But 2015 was a big warning sign. When the results for 2015 came out, we saw 81.5% of the profits being eaten up by interest on debt. That's not good, right? It left them with under 7% slice of the revenue. 68 million, the lowest amount they've made in a long time. And we see a 3-year decline here, right? 230 million profit, 152 million profit, 68 million profit. That's not the right direction that we want to see a company going in, right? That's a bad sign. And then 2016 came along, terrible year. The revenue was down, first of all. The expenses were quite high relative to where they had been. They were quite high up still. And then the interest on debt was at the highest it's ever been. Again, 4 years in a row, we've seen an increase there between 2013 and 2016, to the point where the interest on the debt was pretty much eating up the entire profit. And they reported a £6 million profit that year in their accounts. That's actually what they made. They made a £6 million profit. However, when we took away the £8 million extraneous sale, I don't know what it was for, can't remember now, but they sold something off that wasn't part of their recurring business for 8 million. It meant that the recurring underlying business of AA PLC that year made a £2 million loss. So they took in 935 million, nearly £1 billion revenue, and still lost money. That's a really, really bad sign. And then add that to the previous 3 years of decline and seeing yet another year of decline over this period of time. They are just very, very poor numbers. Not the kind of numbers that we would be interested in investing in whatsoever. We want them going the other direction. We certainly don't want them going down. So straight away, we knew very early on in this analysis that this was not a company we'd be investing in, but it's just got worse. It's just looking worse and worse and worse as we go through this. Now, there was a sign of recovery. 2017 and 2018, we saw a bit more of an improvement. Revenue went up a little bit, but also cost of sales also went up. The expenses were roughly around the same, and interest on debt went down a little bit as well. So there was more profit left over, and as a result of that, they've kept a bit more profit, and things started to look a bit better. Now, we would have been more interested in this company, AA, further down the line. Maybe by 2021, 2020, we may have been contemplating maybe we need to look at AA again. Had they continued that progression, from 7.8% to 11.7% net earnings, and seen better progression. But then 2019 came along and revenue went up a little bit, cost of sales went up more, and expenses went up massively. So we've seen revenue's gone up, but cost of sales has gone up by more, and expenses have gone up by way more. And as a result of that, the operating profit's gone from 308 million in 2018 to only 219 million in 2019. And no reduction on the interest on debt is exactly the same. And as a result of that, these guys walked away with only a 4.3 net earnings, which again was back to bad territory times. And so what this shows us is that these guys have a problem with rising expenses. Their revenue is not growing. Their interest on debt is still well out of hand and way too big, even though there are signs that they have been slowly paying that off and reducing the interest on it. And at the end of the day, the net score, the net earnings at the end of it are just not strong enough. My point being that it wouldn't take much of a spike in expenses or depreciation bill to come through, or a drop in revenue of customers going to a competitor one year, anything like that, to see this company not making any profit. And it's results like this that lead to drop in share prices. Anything like this where we see a drop in percentage of net earnings leads to share price drops. And all of this information added together shows this is not a company that I would ever invest in at this stage. There's no indication from their float in 2014. Things have just looked very poor, and these guys are nowhere near the quality of a clean watch list company. Let's take a look at the chart then, just to kind of get that viewpoint on things as well. And we can see here, let me just get that up. We can see here the chart starts from July 2014. This is again where they floated on the stock market. And you can see the first year wasn't too bad. They got in at about £2.20 a share. That was the valuation. And then they managed to find their way up to £4.30 a share. And then around April 2015, March, May, June 2015, things then started to make a turn downwards. And remember, we saw this in the financials. 2014 was the first sign of concern. That's when they became. That's when they joined the stock market, and they became a company floating on the markets. And then the financials just got worse and worse and worse every year. And even in the recovery period of 2017 to 2018, you can see investors were not convinced. The share price still continued to plummet during that period because they could see things like rise in expenses. They could see things like the revenue wasn't going up. They could see things like the interest on debt was far too high. And as a result, the share price has just gone down. This is the opposite of what we're looking for. We're looking for companies whose numbers are showing growth, not decline. And AA PLC, unfortunately, here are absolutely showing a period of showing 8 years of decline, essentially, and we see this in the share price. The share price reflects the financials, and from a highs back in March 2015 of £4.30 a share, the share price today is 43p. So anyone invested in this company along that period on the way down are just losing money. And again, this is not a company that I would be invested in personally. And so, unfortunately, this big staple, this company that we all know and love, and a household name that's been around for, well into the 80s or before that, you know, that we've all heard of, AA, the car roadside recovery people. They have been floating on the stock market since 2014, and since then everything's looked poor, everything has looked bad. Things looked great before that, but we are not an investor. I'm not getting involved in this company at all. Their share price is very, very cheap right now, but I am not interested in that at all. I do not see signs in the financials that this is a growth company, a company that whose share price is going to go up over the next 5 to 20 years. So as a result of that, AA PLC fail the process, and we will not be investing. I will not be investing in this company. So, episode 1 down, first company looked at. This is going to be a common theme, in so much that there are going to be a lot of companies that do not make the grade for me. But I feel like there is a substantial amount of insight that can be gleaned just from looking at a bad company. You know, sometimes you can look at these good companies all the time, but you lose your perspective on, well, what's the rest of the index like? What are the other companies like? And so I think it's very important that we see both sides. And, you know, there will be times when I will do a video where we'll look at a company that has passed the grade. And there'll be companies that don't, and there'll be other good companies that don't quite make it, but the numbers look good. You know, there'll be a real mixed bag. But for episode number 1, AA PLC didn't make the grade. I hope you found it insightful. I hope you find it useful. Let me know in the comments what you think. Give the video a like if you enjoy the video and you want to see more. It gives me an indication of whether or not people are actually enjoying what I'm doing. Thank you very much for watching, and I'll see you hopefully in episode number 2. Cheers, guys.